This is Red Thread's Origin Stories with your host, Rebecca Hennessy.
Welcome to Red Thread's Origin Stories. In this show, we explore the fascinating stories of how some of the most successful people got started in their businesses and what they're doing today. I'm your host, Rebecca Hennessy. Joining me from Red Thread is Sean Hodgins. And today's special guest is Idan Shoham. Idan is an angel investor in technology startups, focusing in Calgary, Canada, with a particular interest in software companies with B2B business models. Idan is an advisor on the University of Calgary faculty of Science Dean Circle. He founded and sold a successful software company, Hitachi IT Systems in Calgary, with offices, customers, and partners worldwide. Idan is currently involved in developing Technology Incubator in Calgary, and he's promoting economic diversification investment in the technology sector in Calgary, Alberta, and Canada. Idan, welcome. Idan, why don't you start with your story and tell us how it all began with you?
So my backstory is back in 92, I guess. I was just finishing grad school. And at the same time, my dad and a couple of his coworkers were in the process of outsourcing IT from an energy company that they were working at. So they're all engineering themselves out of a job. And so the four of us got together and set up a company to do some software and IT services. And because two of us were related parties and two of us were not, or two of not us, we built a whole corporate structure to protect, the two who weren't family from the two that were, which is funny because over the next 6 or 12 months, the other two guys at different times left to pursue other interests. Like we're all still friends. There's nothing rancorous. It's just, let's try this. Let's try that. More of that kind of situation. So it became, by default, a family-owned concern, which is kind of funny because it certainly didn't start as one. And we were initially focused on what nowadays is called penetration testing. So doing IT security audits for medium to large firms. And I was kind of the technical side of the house, and my father was more the business, sales, marketing, back office side of the house. And we did that for a while, and we kept seeing the same sorts of issues in one company after another, issues to do with identity and password management and things like that. And we had an interest in becoming less of a services company and a consulting firm and more of a product software company. And so we leveraged what money we were earning from consulting to fund the development of products. And by the mid-1990s, we had software that was commercially available to medium to large enterprises to help initially to help their users manage their many, many passwords, because that was one of the kind of common security problems is people had 20 passwords and they would write them down, and then your application security was exactly as good as your building security, and you weren't running background checks on your janitorial staff, were you? So basically anybody that could walk in the door, which is more or less anybody that was motivated, could access all your systems. So we built software to manage passwords, and by the late 90s, we were out of the consulting business as a primary business. Whatever consulting we were doing was related to our software. And we were increasingly selling to big multinationals, companies with 10, 20, 50, 100,000 employees, not, 1 or 2,000 employees. So we grew the business. We grew out of password management into identity management, into privileged access management, which are all just kinds of software that are related to this stuff. And we became more international. We were hiring more and more people. At some point, we opened an office in Montreal just to access another labor market. We had remote staff really all around the globe. And by 2007 or thereabouts, some interesting people from Japan came knocking, and they're from Hitachi, and they were interested in some sort of a partnership. But it became pretty clear pretty quickly that what they were interested in was an acquisition. We hadn't particularly been looking to be acquired, but there's a price for everything. And they offered that price. So they acquired a majority interest in the company in 2008. But interestingly, they weren't interested in running it or in integrating it into any existing company. So they wanted us to retain a minority interest and to continue to manage the company. And so the brand changed, and we became a subsidiary of a bigger company. But it was essentially the same company, still headquartered out of Calgary in Canada, still selling to the same organization, still making the same software. There's exactly zero staff turnover as a consequence of the acquisition. Like, things basically continued under a new brand, which is good and bad. I mean, we didn't get a lot of collaboration from the mothership. I think at the time the thought was to make lots of acquisitions, and because one of the characteristics of our business was that we built a lot of integrations, the thinking, I think, was that we would have insight into other companies that would be good to acquire. But if you recall, 2008, 2009 were not kind in the financial markets, and so that strategy was abandoned because of external factors. So we just continued as a sort of independent company based out of Canada that happened to have a Hitachi brand stuck on it. And that continued until 2019 or thereabouts, when some folks from the mothership came knocking again and said, it's been a good run, but we'd like to own the whole thing. And so we went through a process, and ultimately in middle of 2020, they acquired the remaining equity, and we exited as management. There's a new management team in there. Still the same company, still, the same team by and large, still doing the same things, but, we're no longer a part of that. So after actually running the company for 28 years, we were cut loose and set free. Use whatever euphemism you like. It was a good run. We had a good time, and, now it's on to do other things. So each of us has his own personal interests. For me, it was a chance to go skiing a lot, and to go mountain biking a lot, and to go road biking a lot. But the body can only take so much of that. I can't do that every single day and not kind of collapse. So you need other things, and there's a desire to engage in the community and to give something back. So one of the things that we did about a year ago is we created a company called MTech Innovations, and that kind of brought back the original brand that we had started with. And that's an angel investment company. So the idea is to look for small, promising technology startups and to invest in them, but also to help them grow, to become mentors and supports. And we have access to a whole network of resources, folks that we've met over the years who, can provide assistance on a part-time basis to a small company, whether it's on contracts or marketing or HR functions or software development or anything else. So we can provide kind of functional, operational support for things where a startup needs work, things to be done, but they can't afford a full-time position. So support in that sort of sense. We actually also have real estate. So we still have, as a part of the Hitachi transaction, they bought the operating business. But when we were selling, we actually owned the real estate that the company was running out of. And we retain that. And there's a little bit of space that's unallocated right now. So we have kind of a hot desk co-working space environment. So startups have access to physical space, and that's convenient for us, especially post-COVID, as people start coming into the office again. It's convenient for us to be advisors or mentors for multiple companies in one spot, as opposed to running around the city. So that kind of brings us to what we're up to today. We have this MTech Innovations investment company. It's an angel investor, and our interest is really in investing in companies that we understand. So what do we understand? Well, we built a software company that does business-to-business software, so not really consumer-oriented. We built it out of our location in Calgary in Canada. So, our ideal investment is the same kind of profile, right? Based where we are, doing B2B, SaaS kind of software. Is that strict? No. You could change any of those variables individually, and, if we like the company well enough, we'll still go for an investment. But, that's sort of the sweet spot that we're aiming for. And that's essentially where we are today.
Can you tell me what some of the biggest mistakes startups are making today?
Well, we're really only just starting to see startups because, as I said, we set this up just a year ago. We made our first investment late in the fall, I would say. So what are some of the mistakes? I think it's just readiness, right? So you need to understand, who your market is and how big the market is and what kind of staff you need and who your competitors are and how you differentiate from your competitors. What's special about your product or service that will differentiate and drive revenue and drive growth. And I'm not sure that a lot of startups necessarily get that out of the gate. They get a really nice, shiny idea, and they run with it regardless of commercial merit, I guess you could say.
Idan, do you see that companies that have a shiny new idea lose track by not having an effective plan to execute?
So we haven't seen a lot of companies that don't have a plan, but I think a lot of founders are doing it for the first time. And that means that their plan may be wildly optimistic, right? For example, we're looking at one company and they're looking to expand the business into new cities. So it's kind of a geographically targeted thing. And they have a plan to access other cities, but we think that their projections for marketing spend are unrealistically low, right? So I think you see a fair bit of, haven't done that before and are consequently wildly optimistic.
Do you find that startup companies can be unrealistic about their customer acquisition cost and the lifetime value of their customer?
Yeah, so I don't know that I've run into companies or startups that don't understand that there is such a thing as customer acquisition cost or even have a handle on what it might be. But I've certainly seen startups pitching for investment whose CAC is disturbingly high and treading higher. And that's a problem because CAC you can kind of measure, right? Like you're assuming that you've already got an early product, an MVP, and you're already selling it to a few folks. You've got at least some sense of where your CAC is currently. And if you've been doing it for a year or two, hopefully you've got some kind of trend in it. So you have a sense of whether it's trending up or down, where it's going to go. And you generally weigh CAC against LTM, right? Like LTV.
Yes, lifetime value.
The problem is LTV is more aspirational, right? You hope that the lifetime value will be X, but because the lifetime often is quite long, that's much less certain. And so you wind up in a situation where the CAC is perhaps high and rising, and the LTV you hope is higher, but you don't really know. And that's one of the areas where you get, as an investor, you see a red light flashing, right? It's like if CAC is high and LTV isn't much higher, or if LTV is less certain, then as an investment, it's kind of sketchy.
Yes, exactly. A lot of companies talk about their burn rate, and they seem to have a pretty high burn rate for their first few years. And for many companies, it can be very difficult for them to have enough momentum to overcome that hurdle, a large enough customer base.
Yeah, for sure. And I mean, to be fair, there's a whole spectrum of approaches here, right? So on the one end of the spectrum, you can be profitable really out of the gate. You start doing some consulting, which is profitable, and you feed that back into growth and R&D. So that's a fairly low risk approach. You sleep well at night, but you don't necessarily conquer the market, right? It's like you don't have the same kind of growth trajectory or market penetration. On the other hand, you can blow your brains out and try to grow really quickly and try to be the first mover and conquer the markets. And in that case, you're basically throwing out any notion of profitability for some time, and you hope that when you do turn the business around, it becomes wildly profitable. And the classical case of that is a company like Amazon, which deferred profitability for 15, 20 years, I don't know, and then became like this monster. And I think a lot of folks imagine that they can be that they can be Amazon. And I think statistically, it's almost certain that almost all of them are wrong, right? And but those are really two ends of the spectrum. And the question is, is there consensus around where on that spectrum a company should fall? And by consensus, I mean between the founders and the investors, right? And we've certainly walked away from investment opportunities where we felt that the company, where the founders were too far to one side of that spectrum. Like we couldn't see a path to profitability in the foreseeable future. We liked the team, we liked the company, we liked the product, we liked a lot of things about it. The valuation was manageable, but we just couldn't see where they would turn the corner and become profitable. And so we're like, good luck, I hope you succeed, but I'm not comfortable funding that.
What do you think there, Sean?
Yeah, I was going to just come at this a little bit of a different direction. Just, customer acquisition cost and MVP is a little bit of being asked to how do you calculate this? Being involved with a lot of startups of just looking at how do you calculate that in an early stage company raises its own set of questions on it. Because everyone asks, well, what are your customer acquisition costs? And is it reasonable that, okay, you have an MVP and you sold it to the first 2 customers. Do you actually know what your customer acquisition costs are?
Yeah, and if you're early on, if you've only sold it, like if you're expecting to sell large volumes and you've only sold a very small volume, then your fixed cost divided into the few number of customers will mutate that beyond all recognition. So you may not know what it's going to settle at, but you should at least have a model that the CAC settles at something sane, right? If you've only sold to one customer and you've got 3 people on your team, then the CAC is the cost of those 3 salaries, and there's no way in hell, right, that it's going to be profitable. But you have to project and say, look, I expect that I'll be able to pick up 10,000 more customers, and the CAC will be this. So it's a little more speculative, but at least there's some rhyme or reason to it.
Well, that's where I'm pushing it is that I think at the end of the day, you're hitting on the point. Does the, the founding team, does the CEO know how to manage this, right? With the full expectation that there might be something that is a generic question. What's your CAC, right? And the issue is it's somewhat more involved. Like if it's a minimum viable product, and some of the most successful companies, honestly, their first product offering wasn't viable. Like they managed, and I'll use the term viable simply. Can you get someone to buy it, right? Pay for it, being truly a proof of that viability. But is it going to churn in a couple of months because it's not quite living up to the market?
It's not that good yet,
right? So the issue is that so now you're spending more time with the customer, retaining them, and perhaps bringing your product development and R&D team to the table and going, how do you, what do we need to do to ensure that customer is satisfied? I'm just putting out some ideas here on just giving some advice. And
arguably at that point, you don't have CAC because you don't have an MVP either. Like you've got a demo. Mm-hmm. And maybe it's a revenue generating demo, but you're still doing heavy lifting R&D, and so you're still in the development phase heavily. And I don't know how these things are treated on accounting terms. I'm by no means an accountant or a finance person or a money person. I'm an engineer by training, but I would argue that you want to have something that's in a steady state, both in terms of what the product is. It doesn't mean it stops evolving, but perhaps your investment in R&D is kind of flattened out a little bit, and your customer acquisition is sort of a repeatable, scalable, scaled process before something like CAC makes sense. Before that, you're just playing with numbers.
Well, I think that's the exercise is early on, you have to play with your numbers, right? And so to the point
you're predicting.
It's a best estimate, right? It's like, what do you think will happen? And are the assumptions around what you're estimating, do they make sense? And it's almost, and we tend to invest in the earliest of early things. So it's a little bit of making sure that people understand the complexity here. And they're not answering perhaps even with a with a definitive answer because it's complicated, right? and you need to talk the talk properly. We've brought a product to market. I love early traction in that it proves that there's something there somebody's willing to pay for.
Right.
But it may not necessarily even, because some people are like, we'll sit on a product forever and try to make it perfect and then they're never putting it in front of the customer to challenge whether they actually need it or not. So in those cases, I'm like, hey, try to sell this, because if you can't sell this early, then your vision and opportunity analysis may be completely wasted because you're missing the boat. That early traction, though, becomes, and I'll use Meta Optima as an example, where we had great early traction because you knew that the concept of this product, which was an imaging device for lesions, moles, for the early detection of skin cancer, was a great idea. The issue was then getting it into some of the clinics, and we went to Australia for that. We spent a year working with those to augment the product and improve it, and it was such a vital product development cycle. But on one measure, the CAC was ridiculously through the roof. But that's not what was happening. It was product development.
You're still in R&D. Yeah, yes. I agree, and we certainly experienced that in the company that we built. Is no design, no product survives its first encounter with the customer unscathed, right?
Right. Yeah.
Because you think you know what the customer wants and you build to that spec, and you kind of have to, because you can't come to a customer or a prospective customer and show them nothing. Show them a scribble on a piece of paper an idea. Nobody wants to talk to you. So you have to build it, and then you have to show it. And it has to be close enough to what they want to get them excited and to part with money. But once they do that, they're going to give you a lot of feedback about what they actually care about, which may be different than what you thought they'd care about. And you have to iterate. And, at some point, you've iterated enough that the feedback is smaller. It becomes a sort of steady state recurring machinery. And at that point, CAC makes sense. But until you reach that point, you're just in a customer-informed R&D exercise. And that's nothing wrong with that, right?
Yeah.
So after you have that figured out, what about the scalability? How accurate are companies with the level of scalability and the timeline?
Well, like I said, we're just starting, but I would say that most of the pitch decks and narratives that we're seeing are optimistic. Right? They're not making enough allowance for Murphy's Law and competition and customer budgets and whatever else. They're assuming relatively rapid market penetration. And I've actually seen founders on a whole spectrum here. So on the one end, I see I can think of at least one founder where if he projects he's going to hit X, it means he will hit no less than X. And so his numbers don't look that impressive compared to other founders, but I'm confident that they're going to be hit. And he's confident because he's willing to put some of the investment essentially on ice in trust until he hits certain metrics. On the other hand, I see a lot of founders showing a path to becoming a unicorn, to becoming $1 billion company. Like, dude, you're a one-man shop. You're so far from that, it's not even funny. Right? If you can exit at $20 or $30 million, we'll be happy. If you can go further than that, great, wonderful. But that's not the investment thesis.
Exactly. What do you think there, Sean?
I'd love Idan to talk about valuation, because that was a very good segue of the expectations coming out of sales often comes in close proximity to overinflated valuations. What's your sense of valuation?
So valuation is an art, not a science, I would say. And I don't know how to do it any more than the next person. I do know when I see something that looks too rich for me. And there's been a couple of companies recently that we looked at that we thought, neat company. And then you see the valuation, like, not me, right? So I think founders need to be conservative about their valuation. And that's because when they, I think what happens in some people's heads is they put together a model of revenue growth, and the model is really optimistic. It assumes nothing goes wrong and everything goes right. And then they try to apply a multiple to the revenue that they expect that they'll see in 3, 4, 5 years. And then they're like, okay, that's our valuation. And that doesn't really fly. And it doesn't fly because as an investor, you're looking at a business plan and you're like, let me think of all the things that could go wrong. Especially as somebody who's run a business before, I've had things go wrong. So you think about all the things that could go wrong. And so then you adjust the revenue projections, at least in your mind, if not on paper, based on the assumption that at least some of those things will go wrong. And even if you then apply the same multiple that the founders did, you come up with a very different answer. So I think that's kind of one way to look at it. Another way to look at it is just, every jurisdiction has its own community of founders and investors, and there sort of is a scale at which they tend to operate. And I'm sure it's a different scale in the San Jose, Silicon Valley area than it is here in Canada or in Alberta. So, what I'm seeing in early investments here is companies are trying to raise ballpark $500,000 Canadian dollars on a valuation of ballpark 2 to 4 million Canadian dollars. Same company operating out of the valley would probably be 10x the raise and 10x the valuation, and then they would hire 5x the people. They couldn't hire 10x because the cost of talent is so much higher. And they'd be on a faster trajectory to either explode or die, right? But it is what it is where you live, right? That you have to operate within the market or go somewhere else.
Most entrepreneurs don't take into consideration who they're pitching to, and they treat everybody the same. Understanding the investor you're talking to is most important. Wouldn't you agree with that?
So you have to understand your audience, and your audience is multiple investors typically. So one of the basic observations if you're investing in startups is that it's a high risk, high reward venture, right? The probability that any given investment either goes to zero or becomes a sort of lifestyle zombie company that you can't get your money out of, probability of that happening is quite high, call it 80%. And then so you need a few companies, the minority of companies that you invest in to do 10x to cover the non-returns from the remainder. So hence the high risk, high reward profile. And as an investor, statistically, the way you manage that is you make more smaller investments, right? So instead of investing in one high risk, high reward company, which is insane, you invest in 20. But if you have the same amount of money to invest, then it means that you're making an investment 1/20th the size. Now, at some point, the investment becomes so small that it doesn't move the needle and it doesn't make sense. So if you're looking to invest, I don't know, let's say $10,000, right? You can't hire a person for $10,000, well, maybe for a month or two, right? But it doesn't move the needle on the company. And so on the one hand, you want the investment to be of a critical mass so that it has an impact on the company, so it has a positive result and is likely to generate growth and ultimately a profitable exit. On the other hand, you don't want to put all that much money into one bucket because most of the buckets will get drained, to abuse the metaphor. So the way you do that is you find friends, right? And this is how I came to be in contact with Mark and Sean with Red Thread. They're friends who are looking to also invest in companies. So if you've got 5 investors, each putting in $100,000, then you have a $500,000 investment and something could happen there, right? Whereas if you have a single investment of $100,000, you probably shouldn't bother, right? Then it's going to fail. And so from the founder's point of view, you have to understand that you're pitching to multiple investors and you're looking for them to invest together. And because the community of investors is probably not that large, they'll tend to know each other. So you have to, treat them with equal transparency and respect, because if one of them becomes concerned about your viability, I think all the doors will shut.
Idan, you've laid out a real nice platform here for companies and investors to look at things more logically, and thereby allowing everyone to be more successful. What do you think there, Sean?
Yeah, no, I mean, there's a lot to talk about in this area because it's complicated. I would augment the value of investing as kind of in a syndicate of sort, or having a network. Also complements, it isn't just about the size of the check that's written into the deal. Especially in Canada, we don't have this luxury of the amount of capital that pours into ventures in Silicon Valley. So we've had to be much more prudent with where we spend our money. We do have a very supportive government, but they are not writing big checks. So the value that I've seen in Canadian syndicated investments, and frankly, more so even in the angel networks than perhaps the Canadian venture capital arm, is this more collaborative, hey, I'm going to write a check, but I also might have a Rolodex of people that would open on some business development opportunities. And this is also, I think, a big part of what we're trying to do, or the vision of what Red Thread is trying to bring to the table, is like, if you've got some good practical experience, and you may not necessarily be an angel investor, you can still get in and really contribute to this ecosystem by writing a smaller check, but bringing more value in other ways. It's just a little bit of an overlap of being people hear about, an overly enthusiastic investor, or something who's deemed to be meddling in the company. So that you got to be careful not to fall into that category. But yeah, I'd throw that out as there should be, in this private equity game, there's a lot more that you can bring than if, say, you were going to invest in a public company, which you just have no ability to influence in any way, shape, or form. It's a lot different when you're dealing in private equity in those kind of companies.
Yeah, I think mentorship is key. I think it's key all around. So it's key for the investor because it's one of the more rewarding things you do. Like, you're not doing it just for a financial return. You're doing it for, kind of that human return. And it's key for risk management, right? Because if you have suitable experience and you're able to share it through a mentorship relationship, then you're reducing the risk that the company goes to zero. And it's good for the founders for the same reason from the other side of the table, right? And if you bring in a few venture investors, then they're going to have different backgrounds and they can offer different sorts of different perspectives for that mentorship. So I think it's constructive all around.
That's really powerful. The mentorship can become the most important. And that's similar to what Sean's doing with Red Thread, right?
There are even a couple of companies where I'm engaged on a mentorship basis where I don't think that they're ready for investment. So there's no funds at all, but they're folks that I know. I want to help them. I have some advice that I can give them here and there. And, maybe they'll become investable at some point. One hopes. But even if not, like I said, part of the return of this exercise is non-monetary.
So with most of these companies, what do you see? Are they looking to expand? Are they looking to go public? What do you see as their exit strategy?
It depends on how ambitious they are, I guess. I think most of the companies have a more muted sense of what the possible exit is. So they're looking to be acquired by a bigger fish, 2, 5, 10 years at the outside, for obviously significant more than was invested. And then a few of them have aspirations to become that next unicorn. They want to IPO. They want to be a $1 billion company. As an investor, we tend to take the former more seriously than the latter. Just the number, the probability doesn't support that. It doesn't mean it's impossible, but I don't make investments expecting to win a lottery. Right.
That makes a lot of sense. Now, in the case of your company, were you looking to go public or be bought out at some point? I mean, was that part of the overall goal, or did it all just happen organically for you?
Yeah, I think in our case, it was pretty organic. I think when we started, we didn't really have any notion of an exit. The word exit was not really in the lexicon. So we were running a company to run a company to make money. We were taking money out as a dividend or whatever. So for the first number of years, we weren't even really we were thinking about growth, not about exit. So it wasn't really something that we were contemplating at all. After a number of years, we started to think about an exit, but it was kind of an unsolved problem, right? It was, we'll have to figure that out one day problem, as opposed to this is the exit that we're looking for. And then, at some point, the exit came to find us. Like we were acquired. We weren't looking to be acquired. We weren't looking for an IPO. We weren't trying to exit. But, sometimes situations evolve. So we never really worried about it. It was, it became an open question at some point in the evolution of the company, but it was never really a strategy or an objective.
Did you ever need to raise capital, or were you profitable kind of from day one? Sounded like that was a little bit more of the situation.
We never raised capital, which makes what we're doing now that much more interesting, because it's not like we were on the other side of the table before and now, this is what it feels like on the other side. It's like, this is an interesting table. We haven't seen we knew that the table was out there. We'd never been at this party before, so it's all new to us.
You did mention, and I do like these practical situations. You mentioned yourself that, in the context of your people's projections, that things go wrong. You mentioned that you guys had things go wrong. Can you speak to something of significance? Like we need to enlighten the world that, hey, stuff happens. We saw COVID. All those models just got blown up for COVID. But what was your experience there that kind of
there's things up and down the economic scale. So on the top end, there's macro events. The financial crisis of 08-09 was obviously not great for revenue. So you see macro events. You see entrance of new competitors, and sometimes they're extremely well funded, and they kind of suck all the air out of the room through tremendous marketing spends. So we saw some of that. We had cases where the labor market became tight. So there were times where here in Calgary it became very difficult to hire and retain talent because the oil and gas sector was firing on 10 of the 8 cylinders and offering very high compensation packages, and it was difficult to retain talent. It's very difficult to build product when there's a revolving door around your dev team or services team, right? We had cases where we didn't necessarily understand customer needs, so we were not winning those deals. We encountered corruption. That's very interesting. So, for example, if you want to do business with federal and state agencies, in particular in the U.S., those deals are done by companies like IBM on the golf course. They're not done in a formal procurement process as much as you might think. In fact, I remember one story. When you first run into
these are the good stories.
These are the good stories.
Stuff, you're shocked, and then you're like, so that's how it's done. So I'll give you, for instance, we were pitching to some it was a state agency, and I won't say which agency or which state, so that won't get me into any trouble. And the entire team that was looking for products was advocating for procuring our software. And I was making a presentation. At some point, the current CIO came into the room and said, no, we're buying the IBM product. And that was the end of the discussion, and goodbye. And what I subsequently learned from a partner that was more closely connected and had made the introductions, brought us into the opportunity, was they had a pretty interesting arrangement. So what would happen is whoever occupied the CIO role of this agency, eventually they would retire out. And then for 2 years, they wouldn't do anything. And that's because there's a 2-year mandatory cooling period, right? And at the end of 2 years, IBM would hire that person to golf for a tremendous salary. No agreements, no contracts, nothing untoward was ever done. But it was sort of a tacit understanding that if you're the CIO and you're making procurement decisions, then if you procured a bunch of things from IBM, 2 years after you retire, you would be paid a lot of money every year to golf.
Wow.
Right? All perfectly legal. Nobody ever agreed to do anything illegal in writing or even verbally. It was all wink, wink, nudge, nudge. And it was all after the cooling period. But as a consequence, IBM got all the business, despite the fact that the folks that actually had to deal with the technology that was procured were quite unhappy with the quality of products and services and pricing and so forth.
Wow.
Yeah. So that's an interesting way to do things, right? Now, we didn't have, certainly not the ethical stance to do such things, but even if we were inclined to do such things, we didn't have the financial depth or the breadth of product offerings to play such games. You have to be a very big company selling very many products for very big prices in order to afford playing that kind of game. But that's how business is done in the U.S. government sector, is my understanding.
Sometimes, but
a fair bit of it is done that way.
I think I echo some of my own involvement with some of the larger companies and seeing it. And I have a network of certainly folks that are playing in that realm. So it is actually number one on our kind of red thread theme, which is, it's not always what you know, but who you know.
It's who you know.
If
you're a taxpayer, you should be pissed off, right? But it is what it is. Yeah. So you run into, so back to your original point, Sean, is, examples of things that go wrong. So those are all examples, right? Macroeconomic events, government corruption, competitors popping out of nowhere with big funding and making a lot of noise and taking up market share, not being ready for customer needs, customers not really clearly articulating their needs. Another thing, we saw a lot of RFPs. Everybody knows what those are, right? Requests for proposals. And, sort of the bigger the RFP, the less you want to invest in it because it's built for some market participant to take, right? And so big RFPs are an interesting animal. They're good for no one, right? So if you're the organization that wants to procure something, if you just do the math, right? So let's say you put out an RFP with 400 requirements. Now, any salesperson can answer yes 400 times. So you don't want yes/no answers because they're useless, right? They just mean that a salesperson said yes. Big deal. So what you want is actually for each question to have an answer of how will you do this, not whether you will do this, because then the sales guy isn't technical. They can't pull that off, right? So somebody with a clue has to actually give a believable description of how they do it. So let's say the average description is a half a page of text. So if you put out 400 requirements, you're asking for a 200-page proposal document, right? Now, you don't want to sole source anything. If you were sole sourcing, why would you even do an RFP? So you send it to maybe 10 vendors. So you're asking to read 2,000 pages of proposals? Are you really going to do that?
Yeah.
I don't think so. Right. So there's an argument here to never, ever send really large RFPs. And if you're going to do that, it's not unreasonable for the vendors to look at it and go, well, who are you really going to procure from? Because we just met, so it's not me. So why would I waste my time responding to your RFP? And there's a whole kind of best practices around that. Meet the people, demo first, figure out which requirements every vendor is presumably going to be able to do, and don't bother asking about them. Ask about things that you think might actually be differentiating as opposed to kind of table stakes capabilities. Lots of stuff that you can do, but that's, in the space of how should you conduct your business successfully.
I got another question that came up. And being through the experience, how often do you ever ask for proposal documents from prospective new ventures? Because I'm doing it more and more, which is really understanding how ready they are to sell. Yeah. Like, do they even have a proposal? Like, it obviously depends on the nature of their business.
Right. So this is a proposal by the investor to the founder, or a proposal by
the companies, like I think even in our standard due diligence materials, I don't even know if we ask for the request for the standard proposal template. So you're going to invest.
So this is a proposal that the founders would give to their prospective customers to see engagement.
Yes.
Okay. So that first of all, I'd say that's only relevant in B2B, right? Because you're not going to make proposals to consumers.
Yeah, of course.
In the one company that we did invest in, we did see proposal documents. I don't know if we asked for them or they volunteered them, but we did. It presupposes that they have a running business, right? That they have an MVP and they have paying customers and they're already out there. To the extent that all those things are true, it's a reasonable thing to look at, and it's also an area where we can assist. So, in the company that we founded, we did a really good job of automating that stuff, of having a revision-controlled, centralized content library that was used in all sorts of contexts, including in proposals, and having a whole team of people in different roles in the company, updating it constantly and leveraging it to turn proposal documents around in 2 or 3 hours, not 2 or 3 weeks. So that's both something that's worth looking at as an investor and something that's worth optimizing. So it's worth looking at as a prospective investor, and it's worth optimizing as an invested individual.
Did you, just going down that lane a little bit, did you use a CRM or did you automate it, or was it just manually a built-up library?
We used a CRM, but no, that had nothing to do with proposals. We built tooling from the ground up for proposals. There might be stuff out there today, but we did this 20 years ago, and there was certainly nothing on the market then, and we evolved it for the entire time. So I'm sure they're still using it, because if they were to stop using it, their productivity would drop by an order of magnitude, and nobody would want to stomach that.
Yeah, and the reason I threw that out is there's an acceleration to a CRM when they don't even have a proposal document, right? And it is a logical question to ask a company, like, you've built your financial model in Excel or whatever, and then you're proposing to sell B2B for sure is where this is. Right. So the question is, what's the next deliverable? Do you actually have a proposal document? And then if they don't, then it's like, whereas if they produce this beautifully well thought out proposal document and it's all this
that's confidence inspiring for sure.
Yeah.
So I think we ask a more broad question, which is, tell me about your sales process. Who do you sell to? How long does it take? Do you have a CRM? How do you manage it? Where did the lead gen come from? What's your close rate? Who does what? Show me proposals. Show me pitch decks. Give me the elevator pitch. Like there's a 1,001 kind of sales marketing questions. Show me your website. One way to instantly disqualify an investment is not have a website, or register a domain and not put content on it.
Yeah.
Right. Conversely, if you have something there and it's not very good, but you demonstrate a willingness to develop it, that's a conversation, right? That's something where we can help. So the entire sales process and sales pipeline are certainly of interest, in particular for B2B. But also, B2C is just a different animal. You have to sell. If you're not going to sell anything, then there's no business.
Right.
Exactly.
It's kind of a bigger version of the earlier discussion about CAC, right?
Yeah. Is there any recent companies that you've run into that you've been really impressed by, or vice versa, something that just turned you off, and what were the reasons? So you could probably go in either direction with that question.
Yeah, so there's maybe 4 or 5 companies that we're looking at right now that are, decent chances of getting investments. So for starters, they need to have a really strong team, and that probably sells the company more than any other single variable. Is, as an investor, we want to be impressed by the team, right? So what does a good team look like? It means that whatever harebrained question you throw at them, they know the answer. They don't need to get back to you. They don't need to think about it. Another element of that is the team should not be kind of monochromatic. So what I mean by that is, sometimes you see the team as just money people, right? Just finance or accounting or whatever, or just legal people, or just product people. Ideally, you have a partnership where the founders are plural, and one of them is a super strong product technical expert, and the other one is a super strong business, finance, accounting expert. Right? Because that's kind of the two sides of a typical business. we tend to think less positively about startups where the founder is either just one of those things or straddling somewhere in the middle, right? Which doesn't mean that they're necessarily uninvestable, but it merits closer scrutiny. And we've seen companies that we didn't invest in because we thought the management was just not strong enough. Like, for example, there's a company that we looked at recently where we thought the product was, assuming it passed tests as advertised, phenomenal, but the management team was not. And the inventor, founder of the technology was kind of on his way out for non-business related reasons. And so you have a case where the driving force behind the company is gone, and the new owners are very well-meaning and positive people, but just don't have the skill set to really carry it through. And that's a shame, right? Because there's an opportunity out there somewhere, but it's not going to happen.
Without a doubt. I mean, company culture, maybe you can speak a little to the things that you are doing or that you've seen that are, and I throw out the obvious ones, which is perhaps some stock options or some of these other incentives to keep people around for the long haul. I've also seen the situations of like the PMC Sierras with the fully paid catered cafeteria and that. But in terms of trying to offset perhaps maybe not as competitive salary, which is nature of the Canadian bootstrapping environment, what are you seeing as strategies that you like for the companies you're running into that are addressing these challenges?
Yeah, there's a lot of ways to tackle that problem. So one that we used, I think, quite effectively, well, two that we used effectively. One was having a good work-life balance. So really trying to throttle people's hours, limit them to those 40-hour weeks. And, for technology companies to do 40-hour weeks is really strange. But we really did that. And if you needed to work more on something this week, then you just back the time and, we would pretty much insist that you go do something else next week or the week after or something like that. So that's one way to do it. I think another attractive thing is just the quality of your peers. So that goes right back to the recruitment problem. Right. If you do a good job of recruiting good quality talent, then that will have a fairly direct effect on your retention, especially for people who've worked in a few other places where the recruitment process wasn't as rigorous. They'll generally appreciate more when their peers are productive rather than where they have to kind of pick up the pieces for their peers' inability or unwillingness to work. You mentioned equity. We didn't really have an option of doing that, but that's certainly something that I see in a lot of startups is they allocate a certain percentage of the equity pool for staff retention, and I support that. It's a good idea. Catering, I think, was more early 2000s Silicon Valley thing. I don't see that too much anymore. We certainly dabbled in that for a while, but I don't think it's really. I mean, people should, get out of the building once in a while and get some fresh air. So I don't know if I'm a big fan of that at this point. Career development. I think people want to be learning things and they want to see growth. I think that's very important. That keeps them around. I mean, you circle around all this stuff. Solving a problem that you care about. So the company that we have invested in, they're in the ESG space. A lot of people want to be in that space. They want to work on making the world a better place. So if what you do as a company is attractive, I think that's very good. I think conversely, if you're in one of the industries that is painted, even if your company is well run and positive and everything's good, but if you're in an industry that's seen in a negative light, I think you're probably finding it's increasingly difficult to attract, especially young talent. So like if you're a coal miner or an oil company or a tobacco company or whatever, good luck to you. Right. I think the supply of capital is drying up, the supply of talent is drying up, and the customers are kind of stepping away. So certain industries have an easier time acquiring talent than others. Heck, Facebook has a difficult time acquiring talent because of being involved in political manipulation campaigns and things like that. They've certainly lost a lot of talent to other competitors in the valley, and there's plenty of people down there that will not work for them. So I think being seen to be making the world a better place rather than the reverse is essential to recruiting, attracting and retaining talent. But at the end of the day, you have to pay. The market's expensive and becoming more so.
Curious your thoughts on just annual reviews or the involvement of senior management with one-on-ones or that mentoring or career development. What was your experience? What's your thoughts on that?
We did that. I think it's not a bad idea if you don't take it too far. So if it's a really formal, stiff process, then I think it's more negative than positive. On the other hand, if it's just a venue for people to vent their frustrations and get them sorted, and for more of a mentorship to happen, then I think it's absolutely worthwhile. I think the challenge that you run into is review processes they have two separate purposes, right? So one of the purposes is essentially positive. It's career development and mentorship and making sure that the motivations of the employee and the management are aligned. But the other motivation, which sounds similar but really isn't, is to identify problems and create a paper trail of dealing with those problems in the event that you need to follow through to a termination. And it's really awkward that those two things exist in the same venue, right? Because it creates too much stress for the former, which is mostly what you want to do, on the off chance that you need to do the latter.
That's why I'm pointing this. Like, I'm just thinking about, some of the issues that you run into as, when you start to actually having to run a business. And in these startups, is the company culture, the team is so important. How do you deal with these issues? Sometimes you'll get employees coming in and they'll have some level of expectation, and they should, about, when do they get a raise, right? Like what are the expectations? So that's why I'm just throwing a question or two out there.
I mean, I think transparency is always healthy to the extent that you can, in terms of legal and policy and other issues, be transparent. I think you should be transparent. And I think it's helpful to have kind of a monthly one-on-one for everybody and their manager, just to ensure that bidirectional communication happens about career and happiness and productivity and so forth. Beyond that, it's more a question of what you want your policies to be. But to your point, corporate culture is important, and it tends to flow from the top down.
Yeah, interesting. Very interesting. I'm looking at your list there, Idan, to make sure that on your website, I go with, I used to do this all the time, give us your top 10.
Yeah.
Do's and don'ts. Maybe top 5.
I don't know. Let me go through the list.
Where do you see? Let's start with the don'ts. I always find those ones are the most just don't do this, because it really pisses somebody off or just becomes a showstopper.
In terms of fundraising, you mean?
Yeah. For the founders, guidance for a founder, raising capital. Don't do these 5 things for sure.
I'd say, well, maybe it's easier to say do's, because do's and don'ts are kind of mirror images. I'd say do show either current or clear path to profitability, right? Do show me how you're going to make money with this. Do explain what's differentiating about your product or service. Do explain where the market is and how you're going to capture it, right? What your sales process, what your marketing and so forth are going to be, so that you actually generate revenue. Do identify your competitors and how you're going to compete with them, right? That's a big one. I see a lot of folks that kind of downplay the competition, and that's just not believable, right? That there's always a competitor somewhere. Do show me how it works, right? I don't want to hear about the product. If it exists, you can show it to me, right? If you can't show it to me, you have to at least explain why you can't show it to me, and it better be because it'll be ready next month, not because we haven't started building it or because it's top secret or something. do talk about your team and how you're going to grow your team, because the company is the team is the company. At the end of the day, it's a human enterprise, and that team needs to be strong, it needs to be agile, it needs to be smart, but it also needs to span sort of the commercial and the technological aspects of the business. And if the don't be in one of those silos and not the other. All right, that companies that are purely financial engineering exercises, I'm sure there's a way to make money out of those things, but I don't have the expertise to touch those. Do talk about how you're going to scale up, but don't live in fantasy land, right? It has to be believable. It has to be accomplishable. It has to allow for, Murphy's Law, for shit happens. Things don't always go to plan, and your plan should have enough slack to account for the things not going to plan reality. Do talk about your financials. I'm focusing more on product and service, but the valuation has to make sense. The revenue model has to make sense. The customer acquisition model has to make sense. The customer acquisition cost and sales pipeline have to make sense. You have to talk about ownership and dilution and cap tables. Those are frankly not very interesting conversations, but they're important gatekeeping kind of conversations. They're probably interesting to some people, just not to me. And do be transparent about how much money you need to raise, not just now, but in the future. And one of the don'ts I would say is don't expect to go back to the well for too many rounds, right? So if you're like an Amazon or an Uber or a Google or something, then sure, 4, 5, 6 rounds makes sense. But if you're a run-of-the-mill smaller tech company, if you've got to go back for even a third round, I think that's indicative of execution problems more than growth perspectives. Right?
Yes.
Like smaller software companies that go for like a Series E, they're just dead money.
Your list, which I wrote down, I think are all fantastic. It did also trigger me to be like the what not to do's, which might be an interesting way maybe to ask questions back on this, because it was all like more pet peeves, like what things. And I'll throw like show profitability. I think it overlaps on that. What series do you think, like if you were to have an investor come to you and pitch that even was presenting, and the one that you hear almost all the time, and there's some legitimacy to it, but it irks me a little bit as an investor, is this is the rat raise I'm going to do to get me through to my Series A, right? And somehow that doesn't fit well for me for some reason. Like it's almost like I realize that, but don't pitch it so forward that way. Like almost give me the pitch that would see you through to profitability, which was your first point. Show me how you get to profitability. Is like how much money at the end of the day, and it might be $20 million, and I can make this into an unbelievably profitable company. The secondary thing is how the heck do we split the $20 million up? Because you're not getting a check today for it. Mm-hmm. So it's a little bit of, styles of pitch. On the one side where it's like, oh, give me this money and that'll get through me to Series A, which means I'm going to be back asking for more money, kind of irks me a little bit. So I'll throw that back at you as just kind of what are your thoughts on anything there?
I tend to be with you. I mean, if we're operating, in Calgary or in Vancouver or in Edmonton, these are not huge markets. So show me a path to profitability from your seed funding. And if you exhaust 2/3 of that money and you see a path to bigger profitability that requires more investments, by all means, let's have that conversation. Maybe that's when you bring in other bigger investors to the table. But if there's no possible way to get to profitability just based on the seed funding, that starts to raise questions about, is this really a business? Like, is this a super high risk? Because what's not said in that question is I need a Series A or the business will go bust. right? And I don't really want to see that investment, right? I want to see an investment that can be modestly profitable with a seed investment, and then maybe more profitable with a Series A. That sounds a lot better to me than, tide me over to the bigger, more meaningful investors who will probably dilute you down to zero anyway, and then we'll see, right? Like that doesn't sound like a great deal for an early investment.
Yeah, exactly. Well, I'm going to keep going unless you guys other jump in, but you touched on a couple of things. There's probably a theme here. I'll skip to how it works because then your second item was, how do you differentiate your product or service? But I'll go to the how it works first because obviously there's a big overlap there. But sometimes investors don't like the investor to get too down into the weeds, and I think you alluded to that a little bit. But what's your feel? What's the right balance there between show me how it works and this balancing act between how does the product differentiate itself from the competitive environment out there?
Yeah, so my sense is, depending on your investor audience, you need to be able to go all the way down that rabbit hole. And it shouldn't scare you. And if you can't go down that rabbit hole, that's a pretty big red flag. Mm. And I mean, like I say, I'm more a technical guy. I'm an engineer by training. I was the CTO of a company for God knows how many years. So I will go down that rabbit hole, right? And if it's not really my area of expertise, that just means I'll ask more stupid questions. But I'll still go down to the bottom of the rabbit hole. And as an investor, I feel a lot better if I understand what you're doing down to the bits and bytes. And I will not invest if I can't wrap my head around it. Now, I don't know that I'm typical in that way. I suspect I'm not. But that makes me, on the one hand, perhaps a more difficult investor to attract, but on the other hand, probably a better mentor to have.
I'm right on the same camp as you. And I think Mark would tell you how many times I do absolutely need to wrap my head around it. Otherwise, it doesn't resonate. But there are the audiences out there, the knowledge base that don't go too far down there. Talk about your business. I'm investing in your business, not a product. So that's why I was curious to get your perspective. But I'm on the same page as you.
I don't think those are mutually exclusive. I go down both rabbit holes, right? So I want to understand the technology stack and where it's running and who's building it, and I want to talk to the people who are building it. And I've had cases where I've actually asked and got access to source code to look at it and see, all right, show me your code, right? Like, are you writing competent code? So when I say down the rabbit hole, I'm going all the way in. On the other hand, I also want to see what your customer acquisition strategy looks like, and your CAC model and your LTV model, and how you're marketing and where you're spending and how you're promoting it. And I want to see that too. It's a completely different rabbit hole, but I think both of those rabbit holes have potential to kill the business, right? Like if you're not executing perfectly in both of those dimensions, you're dead. So the more I can see, the more I can get a sense of, is this a real viable business? And the more I can help you if I do invest.
Yeah. And you actually just hit on one where we need to follow up, is just the serious due diligence, right? On some of these things does require going down these rabbit holes. And that's one area I think I've seen it once, of proper source code, sending in hey, Dan, into a company and go, show me your source code. Let me see actually what's going on. Because the reality is you don't have any visibility on anything, even if you're just doing a product demonstration. And I've seen pitches that do mock simulated software, and it looks amazing. But the reality is there's no code there at all. So that's where it's the interesting one. But man, is that important to get your head wrapped around, because the simulators are really good.
We've only been doing this for a short time, and I think I've looked at source code for at least 3 of these companies so far. Maybe more, but certainly 3 that I can think of off the top of my head that I taught to the developers, and they, it's all right, show me the code, and 2 things come out of that. One is I get a sense of where they're at, and 2 that they get some free advice usually.
Sure.
And in one of the cases, it just gave me GitHub, like it was on a GitHub thing, it just gave me access. It's like, okay, go nuts, read only, access all you like. Here's 8 repositories, have fun. And that's actually more difficult because then it's not a guided tour. It's more of a find your own way.
Sure.
But it's a real quick way to tell how much is real and how much is, imagined.
Complete. I'm going to come back to the competitor one, but team and company, 2 pet peeves. I'll throw one. One is checking their LinkedIn profiles. Members of the team that don't actually identify themselves as on the company who's pitching's team.
Or part-timers, right? So they show up on the team, but they're really not doing this full-time. If I see a big name advisor, I'm basically out, right? Because I know that they got 100 things going on, so they're just lending their name to something.
Well, the way that we've been calling that out is asking them very directed question when they put a big name advisor in. How much of this round are they participating on? And I would say I'm at 100% of they're not interested in it. That's like they're there for their resume, but that's a showstopper for me, right? Is like, what if you put them into your deck and they aren't actually investing into your story, then if anybody would be qualified to invest in it, would be this person. So it's a funny juxtaposition there when they're putting this forward right in front of you as here's why you should invest. Becomes an obvious, well, how much did they invest? And when they say no, it's like, is this a problem? So anyway, it's funny that does occur often. And that would be one of the don't do this unless they are really into it. Like if they're like, obviously you have a great, and they're putting an investment in and they're actually part of your pitch, maybe even. It's just
a bigger pattern, right? No bullshit.
Yeah.
Just tell me what's going on.
That's another one. Don't lie. If you get caught in any sort of exaggerations and lies are like a little bit of that situation.
Or emissions. Emissions.
Yeah. Emissions, we strongly encourage us like footnoting things. Like if you put some statistics in there, it just gives whether the person's going to look it up or not, it does. Because sometimes they're just, this is a $7 billion industry and you just know it's coming out of nowhere. And I don't care.
I don't want to care. I want to see what you're going to make, not what the other people are making in this business.
Right. Yeah.
You can forgive a lot of red flags when they're newbies, right? When they're really green at raising funds and they're following a recipe and the recipe shows do X, do Y. There's no substitute for a conversation.
Yeah. Absolutely.
So how important is it for a company seeking funding to have an organized presentation?
I will throw it to Becca, like we do, and this could be a question back as well, which is just the energy level, the presentation style of some of the CEOs, like how to, and that's where it's like Becca and Ed, we got a whole bunch where it's like, we got to send, because Becca will send, she does this amazing presentation. Her background is obviously as a country singer. Her confidence speaking is fantastic. So it's like a lot of introverted, maybe software developers or somebody that are quiet, their style of how they're presenting isn't exuding a leadership quality or the confidence necessary to get an investor excited. What's your take on that, Idan?
You want a leader that behaves like a leader. It's as simple as that. Like if they don't project the energy and the agility, the mental agility and the organizational agility to lead, then the company will fail. It's just a given. And the converse may well be true as well, which is if you have a sufficiently strong leader, your company may not be that strong, but somehow you'll find a way.
Idan, I want to thank you for a great interview. You really put out a lot of valuable information that'll be beneficial to a lot of people. Thank you, Idan. And thank you, Sean. I look forward to seeing you again. Please join us next time on Red Threads Origin Stories.